Please welcome to the show America's accountant, Dan Geltrude. Dan, thanks for being on. Now, I'm glad I wasn't here because I would have been frustrated, right? I mean, I felt as though that these job numbers would finally come to fruition and they would slowly but surely start to break at market. But I can't say that they've really, really broken it. It just missed expectations by a little bit. And this idea that we're going to be cutting rates sooner rather than we thought, I don't know. What are they smoking? Or maybe you agree with them. What say you?
Well, I don't agree with them. Listen, these job reports do not reflect the true state of the economy. You could look at statistics and numbers and do all kinds of analysis and come to whatever conclusion that you want, Scott. So I'm going to take that path and say, here's how I see it. Okay, so they missed. What's it mean? To me, very little. And I'm actually surprised Wall Street would be reacting so emotionally to this. They should know better than to look too far into these job numbers, right? So many aspects here are skewed. So I'm going to tell you this. I do not believe that the Fed is done with raising rates. And the reason I say that is simple. You said it during your monologue. Is inflation actually improving? The answer is no, it is not. Right. Stuff is still way too expensive. So why would anybody think that it's going to be a permanent pause or even yet go into 24 and there's going to be a rate drop? I just don't see it.
Right. And so I had to go away and have a little bit of a think for myself, which at times can hurt. But I wanted to see why we saw that 10-year yield go from, basically 5% down to 4.5% as quickly as it did. I mean, just in the maybe short few days that I was out. And here's what I came up with. And I want you to tell me what you think. I mean, number one, one of the biggest reasons, obviously, the market will blame it on the jobs numbers, right? We broke the jobs market. We haven't broken the jobs market per se, but I think that the market took that as we're done hiking. I don't believe it, but I think that's what they're thinking. The other one is I think that we had the weak hand was short bonds, right? And so they were thinking that the market, those rates are going to continue higher. And when it didn't work out for them, they had to kind of cannibalize themselves and buy bonds to get back out, sell bonds or whatever. I think that the market was overshort the bond market, thinking that yields are going to rally. And when they didn't get what they wanted, they had to buy those bonds back, right? So I think that's part of it too. And the last one is there's been a flight to quality with what's been happening over in the Middle East, right? So when you buy our bonds, when you get cannibalized out of your short position, or you buy it because it's a place to run to quality, the bond price goes up and those yields go down. I think those maybe were three factors. Do you have any more, or maybe you disagree? Who knows?
No, I actually do agree with you, Scott. Listen, for all those investors out there, this is a tremendous opportunity to diversify your portfolios with bonds. Listen, 4.5%, 5%, I will take that all day long right now. And I think the bond markets are going to go back up. And you want to know why? Because the economy is fueled by debt. As well as our entire federal government is fueled by debt. So I don't really think that the bond market has even seen its worst days. I think there's better days to come for the bond market, and conversely, not so great for the stock market, because if they're betting on the Fed, and what I mean by that is that there's going to be a reduction in rates within the next 6 to 8 months, that's not a bet I'm taking.
Well, because that's like betting on the sun exploding, right? Because what do you win if you're right? I mean, that means that you think that there's going to be some sort of financial calamity out there that we're going to have to be cutting rates sooner rather than later. That's why they would cut rates, not because of job done, mission accomplished. It's going to be because something bad out there happened. And to your point about raising money and bonds, look, we reported last week, I think it was Wednesday, that the Fed's going to have to sell, or at least raise, $8.6 billion a day for the next 3 months. I mean, they're going to be selling bonds throughout this whole time. Who's going to be the buyer? 60% of the bonds bought last year were by the Fed itself. Right? The biggest buyers left the market, and arguably they might be selling bonds to kind of clean up their balance sheet. So I agree with you 100%. I don't know where this euphoria came from. I just feel like we had some weak hands. There were short bonds thinking that these rates were going to go higher. Didn't work out. Bonds rallied, yields plummeted because they had to get out. What do you think?
Yeah, and I think there was a lot of wishful thinking and hopeful thinking. And you know, Scott, hope is not a good plan. And that's what I think they were looking at, and they were all wrong about that. And it wouldn't surprise me if we see a reversal of that much quicker than it's going to last.
And always, between the two of us, we probably have 70 years experience. Ish Kabibble, when you see these things happen like this and everybody thinks game over, done deal, it usually comes back to bite them, I think, in the end. So we'll see. But that's what my experience tells me. I appreciate you coming on, Dan. That's awesome stuff. As usual, Dan Geltrude, America's accountant. He knows what he's talking about. He's a numbers guy. We got to listen.